Hello, in this lecture we will continue with chapter 22 and we are continuing on the master budget, and what we have done so far is had the sales budget, the production budget, and now we're taking a look at the direct materials budget. So now we know how much we need to produce in units, we know how many we're going to sell, we know how many units we need to produce. Now we need to look at the materials to produce them. So we're producing hockey sticks in this case. We know how many units we need to produce. Now we need to look at the actual units that we're going to go into those, and I'm assuming it's wood or fiberglass are the materials that we're going to have to purchase in order to convert those materials to the finished product being the hockey sticks. So the direct materials budget shows the budgeted costs for the direct materials that will need to be purchased to satisfy the estimated production for the period. So we're going to have a similar type of calculation. We've got the budgeted production units, and that's going to come up from the last calculation, the production calculation that we had prior. And remember, it's not the actual units that we believe we're going to sell. We had to take those sales units and then account for the ending inventory and the beginning inventory to come up with the amount that we believe we need to produce. Then we're going to multiply that times the materials required per unit. So this 0.5 does not mean 50% in this case. It means something like 0.5 planks of wood or something like that, or 0.5 fiberglass that we're going to need to put into the hockey stick. So we're talking about units here, not dollars. That gives us the materials needed for production if, once again, if we did not already have some materials on hand. Then we're going to add to that the budgeted ending inventory. So this is October. As of the end of October, we want to have on hand 335, or we're budgeting to have a cushion of 335 over the amount of materials we're going to need to use in the month of October. So that means we would have a total materials requirement of 690. That's how much we would have to buy if we didn't already have some on hand from the end of September, which we do, and happens to be 178. Therefore, the 960 that we're going to need to produce minus the 178 gives us 512 units. So that's how many units we need to purchase. Then we're going to multiply that times the purchase price. I'm assuming that's like wood or something, or fiberglass, times $20 per unit. That gives us the dollar amount. And then again, we could do a similar process throughout November. So we have 1,340 from the production calculation for the month of November, times 0.5 planks of wood or fiberglass per unit, the units needed to make the hockey sticks, means we're going to need 670 materials needed for production. We're going to add to that what we want at the end of November in terms of our ending inventory. That means we need 907.5 units to purchase if we did not plan on having an ending inventory at the end of October, beginning inventory then at the beginning of November. We subtract that out, we need 572.5 units that we'll need to purchase in November. If we multiply that times the unit price 20, we get 11,450. And so on and so forth. So then we can do the same thing for the direct labor. Now the direct labor is a lot more straightforward because of obviously we don't have any beginning balance direct labor that's left over that we can still use, and we don't have any ending direct labor. All we have is the labor for each time period. How many hours is it going to take? What's the cost for the direct labor? So the budgeted production units, how many units we need to produce again, is going to be the 710. We believe it's going to take 0.25, 25% of an hour in order to do that. So the only thing to be careful of is if you look at other problems and there's some conversion issues between minutes and fractions of an hour, just be careful obviously that an hour is not base 10, 60 minutes in an hour. So when we talk about a fraction of an hour, it's not the same as many minutes, which can be easy to overlook sometimes. So just keep that in mind as we go. And obviously when we think about wages, we usually think about hourly wages. So we oftentimes, if someone breaks it down into minutes, we're going to want to try to convert it to percentages of an hour. Then we're going to pay $12 an hour on the 177 needed in this case. Therefore, we got the 2,130 in order to produce the hockey sticks that we need in October and so on for November and December. So it's a much more straightforward calculation for the labor that we need to make our inventory, in this case, hockey sticks. So then the factory overhead budget shows the budget cost for factory overhead that will needed to complete the estimated production. So overhead, remember, is all that other stuff that we put into the bucket. It could be depreciation in the factory, it could be supervisor salary. In this case, all we really need to know in this case is we broke it down to a variable portion, and a fixed portion. The variable portion of factory overhead is assigned at a rate of 250. Again, we're going to have to take the book's word for it in this case. Obviously, that calculation, we have to figure out what is the variable portion. But once that has been done, then all we need to do is take the budgeted production in units again, how many units we're going to produce, and multiply it times that variable rate that we have been given. That will give us the budgeted variable overhead for each month. And then the fixed portion is very straightforward. It's going to be fixed throughout the month. So if it's something like depreciation on the factory or rent, then those will generally be a typical type of budget where it's going to be pretty similar from month to month, the same in this case. And we're going to just have the 1,005. There's the budgeted total overhead. Then we have the production budget per unit. So we could break this down to how much will it cost us per unit, which could be helpful when we're trying to think about prices in the future and that kind of thing. So with the information from the three manufacturing budgets, direct material, direct labor, and factory overhead, we can compute TSC's production budget per unit. For budgeting purposes, TSC assumes it will normally produce 3,000 units of product each quarter, yielding fixed overhead of 150. And TSC's other product costs are as follows. So now we can break this down to how much it's going to cost us per unit. So we're going to say direct materials, 1/2 pound of materials times $20. That costs us $10 per unit. We have the direct labor at 25% of an hour, 0.25 hours, times the hourly rate gives us $3 per unit. Variable overhead is the 2.5, which was given in the problem. And then we got the fixed overhead, which is the 4,005 total fixed overhead divided by the units gives us the 1.5. Add that up. We're thinking it's going to take a total product cost per unit of 17 now. Now, keep in mind when we do this calculation that if the number of units change, then it's going to be hard for us to budget. We're going to have to figure things out. The reason being is that we have variable costs here and we have fixed costs. So if we produced more units, this number per unit would actually go down and these numbers would go up at a constant rate. So when we start thinking about budgeting later on, we might try to do other types of things at times, such as take out the fixed portion and put that in afterwards or something in order to make a flexible type of budget, which we'll talk about in the future. So then we have the selling and expense budget. The selling and expense budget is an estimate of the types of amounts of selling expense expected during the budget period. So TSC pays sales commission equal to 10% of total sales. So the salespeople make the sales, we're going to pay 10% for whoever makes the sales. Obviously, that will change kind of in a variable fashion with sales. And then the TSC pays a monthly salary of $2,000 to its sales managers. So the sales managers then have a fixed cost, and that's going to be a period cost, not in the production process. It's going to be a period cost, and both of these are going to be period costs, but one is variable and one is fixed. So it's going to be a fairly straightforward type of budget. We're going to take our sales, whatever the sales may be. Again, this isn't production in this point. Now we're talking about the actual sales numbers times the 10%. That's the commission rate, and that will give us the sales commission. And then the sales manager, again, it's that easy type of expenses, which again, a lot of expenses in the general administrative will be fairly straightforward in that they're going to be the same each month. So if we pay someone salary, no matter what happens, they're going to get paid that straight salary, and that will give us our total expenses for selling and administrative. Then we have the general and administrative expense budget. The general administrative expense budget plans the productive operating expenses not included in the selling and expenses or manufacturing expenses. So this is going to be like the office building, like the accounting department, like some of the management. And once again, this is usually more of a fixed thing because these individuals, they're going to be period costs rather than part of the manufacturing process. We're generally going to expense them. And they are usually oftentimes, again, more fixed in nature. So oftentimes this is an easier process. So Toronto Sticks Company has general administrative expense salaries of $54,000 per year or $4,500 per month. So that's pretty basic. So we're just going to take that, again, salary. It's going to be the same each month no matter what production is. And so we just break that over the years, and there we have that information. So Toronto Sticks, okay, we have that. And then we have the capital and expenditure. So the capital expenditure budget shows dollar amounts estimated to be spent to purchase additional plant assets the company will use to carry out its budgeted business activities. So TSC does not anticipate disposal of any plant assets through December 2015, but management is planning to acquire additional equipment for $25,000 cash in December 2015. Since this is the only budgeted capital expenditure for the quarter, no separate budget is shown. So it's because it's so basic, they're saying there's no big activity that needs a large budgeting process or plan. Therefore, there's no added form that we're going to include for this information.